Before we close this section of intermarket analysis, we will also place emphasis on the relationship between commodities and currencies, which is deeply intertwined to the factors like trade balances, inflation, and global economic cycles. The strength or weakness of a currency can influence commodity prices, and conversely, commodity price movements can impact the value of a currency. Here are the key characteristics of this relationship, along with historical examples that validate these dynamics. Let's start with commodities that are priced in US dollars. Most global commodities, including oil, gold, and agriculture products, are priced in US dollars. When the US dollar strengthens, commodities become more expensive for foreign buyers, leading to lower demand and price declines. Kind of a self-correcting effect of too high prices, if you want. Conversely, when the US dollar weakens, commodities tend to rise as they become cheaper in other currencies. For example, during the 2014-2015 oil price collapse, there was a US dollar strength. The US dollar index surged due to Federal Reserve tightening expectations as well, coinciding with the fracking ambitions of the US. WTI crude oil fell from $100 per barrel to below $40, reflecting reduced global demand and a stronger US dollar. Let's bring now also commodity exporting nations and their currencies into the picture. Countries highly dependent on commodity exports, for example Canada, Australia, Brazil, as well as Russia, often see their currencies move in sync with commodity prices. When commodity prices rise, these currencies' trade balances improve, leading to stronger local currencies. When commodity prices decline, the opposite occurs and the currencies depreciate. For example, in the 2000s commodity supercycle, we saw Canadian dollar strength. Oil and metal prices surged due to strong demand from China. The Canadian dollar appreciated against the US dollar as Canada's economy benefited from rising energy exports. As well as what role does gold as a safe haven and inflation hedge play? Gold tends to rise when the US dollar weakens, acting as an alternative store of value. During periods of economic uncertainty or high inflation, investors flock to gold as a hedge. For example, in the 1970s during the stagflation, after the gold window was closed by Nixon, there was an adjustment in the price of gold in terms of dollars. The US dollar weakened due to inflation and economic stagnation as well, and hence the gold price surged from $35 to over $800 per ounce by the end of the decade in 1980. Furthermore, in 2008, in the financial crisis, there was also a gold surge. The Federal Reserve's aggressive monetary easing weakened the US dollar. Gold rallied from $700 to $1,900 per ounce by 2011. How do oil prices and inflation expectation affect this relationship? Rising oil prices increase inflation, prompting central banks to raise interest rates, often strengthening a currency. When oil prices decline, inflationary pressures ease, sometimes leading to looser monetary policy and a weaker currency. For example, the 1973 oil price shock. OPEC, the Organization of Petroleum Exporting Countries, imposed an embargo which led to skyrocketing oil prices. Inflation soared and the US dollar weakened as the US faced economic distress. And last but not least, what about currency pegs and the effect on commodities? Currency pegs are fixed exchange rates. Some countries peg their currencies to commodities like oil or gold, and when commodity prices fluctuate, maintaining these pegs becomes difficult, leading to forced devaluations. For example, Saudi Arabia and the so-called oil-backed peg to the US dollar. Saudi Arabia pegs the Saudi Riyal to the US dollar. During low oil price periods, for example in 2014-2020, maintaining the peg puts pressure on Saudi reserves, meaning that they splash US dollar reserves in the forex market to buy Saudi Riyals to prop up the value of the latter. To conclude, the relationship between commodities and currencies is complex but follows some key patterns. The US dollar and commodities have an inverse relationship due to pricing mechanisms. Commodity exporting nations' currencies move with commodity prices, for example, the Canadian dollar, the Australian dollar, or the Brazilian reais. Gold serves as a hedge against currency devaluation and inflation, and oil price fluctuations impact inflation, interest rate, and central bank policies.